people are talking about maybe they haven't hiked enough and that there is momentum underpinning some of the inflation and the market that previously had been underappreciated.
Yep.
What's your view?
Yeah, look, so first of all, thank you. Good to be here. Good to be sitting at PGIM. It's been great so far in my grand total of 3 weeks. But it's been awesome. Great team. Yeah, look, I think that my view in that regard hasn't really changed much. I mean, I think that in so many ways, I think that the Fed was fighting yesterday's war on inflation. I mean, inflation is softening. I think what we need to make a distinction here between, though, is, and I think Powell laid this out so perfectly, which I haven't said many times, but I think he nailed it. I think, what you want to see is inflation slow credibly and sustainably. Those are his words, and I think that's where we're going. So I think the sort of the construct around that, though, is, does that mean you have to get to 2%? And I think the answer to that is, I don't think we do. I think that's the ultimate objective, but I don't think that is a roadblock to the Fed cutting rates at some point. And we can still see a scenario where the Fed actually is cutting rates, sort of sooner than later. I mean, it's not necessarily this year idea, but I can see a scenario where the labor backdrop is slowly deteriorating, which it is right now. I mean, jobless claims notwithstanding, we're in sort of a funky seasonal window for those. But I think if you get toward the end of the year, and if the Fed's forecast for the unemployment rate materializes, and if their inflation forecast materializes, I think that might be enough for the Fed to say, hey, you know what, maybe we're going to take back some of this aggressive accommodation. And if they did that, could be fuel to the fire from an economic perspective. I mean, you can actually wind up having a really good 24. So it's sort of an interesting thing that we've been kicking around.
There's something you said that builds on what Adam Posen was talking about that's really important to highlight, that inflation may be okay at 3%. And the Fed may even verbally acknowledge this, that they're okay with this and they're not willing to compromise the labor market in order to get inflation down to the prior target. Are you expecting that to be explicit by the Federal Reserve?
I don't think that they can say that explicitly, because then I think all of a sudden it throws into sort of question the credibility around inflation and the inflation target, which, let's just be clear, the inflation target is literally a finger in the air, right? I mean, there's no real literature that says 2% is the number. I think the narrative is, I can see a narrative evolving this way. It's really easy to say that you're going to beat the heck out of inflation when the unemployment rate's sitting at the lows. I think it's a completely different dynamic when the unemployment rate is actually starting to drift higher. And that's a scenario that we could easily see play out over the course of the coming year or so. So I think that's how the Fed is going to be able to justify, hey, look, the credibly and sustainably idea, it's happening. We're seeing it actually drift lower. But now we have to start to worry about the other side of the mandate, the labor mandate, and we can easily start to take back some of this accommodation, some of this tightening. I think that's how the narrative can. So I don't think it has to be like this big weepy, hey, we have to cut. I think it could be, hey, we're going to cut because we want to extend the cycle.
There's a larger question here about what that means about interest rate sensitivity of this economy and whether we're in a new paradigm where there isn't necessarily the same kind of sensitivity and rates can be higher for a longer period of time. Is that kind of what you're seeing?
Yeah, so it's, one of my prior bosses loved to tell the story about how they knew that the Fed cut rates, right? It wasn't as simple as looking at your Bloomberg screen. I mean, you literally had to go to the Fed, you had to get one of the H reports, you had to do all this analysis, and this all happened over the course of multiple days. Why do I highlight that? Because in an age where Fed officials relentlessly have a microphone in front of them, this notion of forward guidance, I think, is very real. So I think the Fed can impact the term structure much further out. And so I think in that context, yes, I think, the Dudley piece that a lot of people were talking about, I think that that's fair. I think that, the economy feels the effect of this much quicker. I would add one other thing, though, that's really important. And maybe this is blunting the blow of this. You think about corporations. Corporations are sitting on a mountain of cash, and they've termed out a lot of their debt. Right, so you don't have that impact right now, and I think that's really an important idea. And I think, and I'm sorry, I'll be really quick on this. I think that's an important idea because when I think about labor and the possible deterioration, thank goodness we got that productivity number, because productivity has been poor. And when you think about the hoarding idea, and Mike mentioned this, and I think this is such an important idea, I think the hoarding idea could actually come back to haunt the labor backdrop. Because if you have hoarding that's taken place as productivity is actually not performing that well, all in the context of companies' ability to pass on prices, which is now diminishing, all in the context of consumption, which is sort of pretty soft, what do companies do to defend profit margins? They will tend to go after labor. So I think it's a really interesting idea that is not being talked about enough. And yeah, sure, I think that the companies probably have deflected some of that because they've been able to term out debt and they're sitting on a mountain of cash. I think it's an interesting idea.
That is fascinating. Yeah. Going forward, as we take a look at when that recession does come to pass, everyone seems to be pushing out their expectation of that. Definitely. Have you as well? Yeah, so our call at PGIM is that we do not suffer through a recession, that it's really more of a sort of, we're calling it weakflation. It's a dynamic where inflation remains north of target, but growth remains pretty sluggish. And that's what we expect over the coming year. The risk to that is what I've just highlighted. If companies actually decide, okay, margins have compressed enough, we're going to have to take it out of somewhere, that's a risk to the labor backdrop, to be sure. But I like our view that that things are probably going to hold in there and not go through the recession line. I would say one quick thing, if I can. It's interesting, this idea of recession and it not materializing. It's been interesting. One of the things that we've talked about, and again, this is a view that we have now at PGIM, is this sort of, it's almost like a mid-cycle slowdown sort of dynamic, right? Like 94, 95. And that's something we've been talking about in my prior job. And I think about that today. And for some of the recession calls out there, think about the things that were in recession. Right? Consumer spending on goods was in recession. Housing was in recession. CapEx, right, was down, in 2 of the last 4 quarters. So there were a lot of segments of the economy that actually were performing really poorly. It just didn't all sort of conspire at the same time. So it's just, again, another interesting sort of angle on that idea.